Kevin Ferry, Chief Market Strategist at Cronus Futures Management from the CME, and Ron Ianieri from Options University joining us live for a nice change out of our studios up in Hong Kong. Picking up where we left off, guys, what happened on Wall Street overnight, both of you agree, is proof yet again that, look, anytime we've got a bear market rally, it's a sucker's rally. This thing is not going to last because there's more downside to go in both the credit crisis as well as the housing market. If true, and the thing to do is to stay away, what do you do then, Kevin?
Well, I think that obviously the most conservative investments are still in the United States Treasury market until the dust is completely settled. But I would take a little bit more optimistic view, and that is purchase the markets or look for investments when the market's down. I think the difference here is that you're at a stage as opposed to a highly leveraged market that you can easily follow the momentum up. That's not the environment we're in by any stretch of the imagination, but there's still some opportunities if you're neither a borrower nor a lender in the United States.
Like what?
I think there's still opportunities when the market's down.
Like what, Kevin? Can we pin you down on that?
Well, I'd rather not get into individual issues from our standpoint, but I would say that if you looked at certain sectors, maybe not necessarily the financials with the high volatility, but you can see that the multinationals, consumer cyclicals, very conservative stocks, when the market's down, are presenting themselves at fairly significant discounts and long-term values. That's totally different than a high volatility trading market, which is really where the real news and real focus has been.
Ron, good morning. I've got a question for you. One of the big themes in the past month or so has been this sharp pullback in commodity prices. In your mind, does that present a good entry point for some investors who may have missed the boat the first time round, or do you think there's just too much volatility in the commodity markets?
Well, there's obviously a lot of, I believe there's still a lot of opportunity there. This, I believe, is just a simple correction. You've had a major run-up. A major run-up normally creates an opportunity for correction. My thing is that, being an option trader, I might have a little bit of an advantage, say, over Kevin, in a sense that, when I see a down market, I don't think that there's still opportunities. There are gigantic opportunities always in down markets because as an option trader, we can very easily play the down markets. So people have to understand that the market is a two-way street for investors. There's up and there's down. There's not bad and good. And unfortunately, a lot of TV shows bring experts on, and the experts kind of treat it as if an up market is a good market and a down market's a bad market. But investors need to know that that's not true. There's up, there's down. There's no good or bad. There's only good if you're in the in the right direction, and only bad when you're in the wrong direction. If the direction is down, let's play the downside. We could do that very safely and very smartly using options.
All right,
Wipe up the trend.
Ron, okay, let me quickly jump in here. How are you playing this down market? For example, Sri was talking about the sell-off on commos across the complex. Are you, like a lot of hedge funds, are you shorting oil?
Well, what we did was we saw an opportunity where oil started coming off, and what's going on in China with the Olympics gave us an idea that there might be a little bit of a decrease in demand from over there for a little while. And it came at a time where oil was at a technical high. On top of that, all you have to do is understand that you can very comfortably play the downside using puts. And as the retraction occurs, you might get some type of Fibonacci-style retracement. You're keeping your eye on some of your technicals, Fibonacci's, possibly pivot points, whatever. And when you think that you've gotten to a technical bottom, you could look to take your profits off of your puts and potentially re-enter for calls. There's a very simple charting pattern called an ABC charting pattern, where a stock gets a bullish run-up, gets some type of bearish retraction, and then starts its run back up again. It happens very often in all different markets, and there's also an inverse one where something goes down, like the market in general right now, comes back up a bit, and then starts selling off again. And all of these patterns are easily played in any direction, so there's always opportunity.
All right, Ron, thanks for that. Kevin, if I can just go back to you, do you think that these valuations and the sharp reversal we've seen in some of the stock prices and the resources present opportunities for consolidation, as we've seen Xstrata make a move on Lonmin? Do you think we will see more M&A in the field?
Well, I think probably in 2009, absolutely. Between now and the fourth quarter, I would say it's more pencil work behind the scenes than headline work. But you've got to heal the credit situation here in the States before M&A comes back to the foray at all. But there is definitely some hunting going on, and I think it's smart to keep your nose to it. But I would look for that to be a much bigger factor for the market overall in the first half of 2009, and look for a much quieter situation in the fourth quarter here in the United States.
Kevin, thank you so much for joining us today. Kevin Ferry, Chief Market Strategist at Cronus Futures Management, and Ron Ianieri, Chief Options Strategist at the Options University, is staying with us.